Welcome to the second quarter investor live stream. I am Rocky Peterson, VP of Investor Relations and Lead Designer. I'm going to read a quick disclaimer and then we will get right to it. In considering the performance information discussed today, prospective investors should bear in mind that past performance is no guarantee of future results and that there can be no assurance that projects will achieve projected results. In addition, actual future conditions may require actions that differ from those contemplated at this time, and prospective investors are cautioned not to place undue reliance on these projections. Certain statements such as believes, anticipates, plans, intends, expects, target, preferred, and words of similar import constitute forward-looking statements. Such forward-looking statements involve known and unknown risks, uncertainties, and other factors that may cause the actual results, performance, or achievements to be materially different from any future results, performance, or achievements expressed or implied by such forward-looking statements. Now, to get to it on this live stream, we also have Jamison co-founder and CEO of Neighborhood Ventures, and John Kabrowski, co-founder and president of Real Estate. We will be taking questions via text option, so please keep your microphones muted during the event. If we don't get to your questions right away, we will follow up with you personally. Custodial accounts are third-party accounts created through our trust company that can receive disbursements from your investments. The benefit to a custodial account is that it allows us to disperse monthly. You have access to these accounts and can either transfer to your bank account or you can redeploy those funds into future Neighborhood Ventures projects. It's worth noting that all distributions, whether received quarterly or monthly, will come from Prime Trust, our trust company. If you don't have a custodial account yet, you can call our office or reach out via email to support@neighborhood.ventures. I'd like to note too that we offer the Neighborhood Venture Fund, which is open to accredited investors nationwide. It's a 5-year hold period and offers the same 12% annual return and progressive cash disbursement. We've deployed over $900,000 over 3 projects and are beginning distributions on the fund next month. I am now turning the time over to John Kabrowski, who will give us a look at what's ahead.
So great place to be, Arizona, except for in the summer. We have the strongest migration, rent growth, and projected economic growth of any state in the States right now. So that's an amazing thing comparing to where we were 15 years ago. Another interesting fact, people are moving here in droves, but most of them are bringing jobs. We're using our resources, using our housing, our freeways, but a lot of them are coming here and bringing their jobs because they're allowed to work remotely. So that's an interesting thing about life, that people are going to live, and we're still having a hard time attracting employees, even though people are moving here. I don't think I got the next slide popping up here. There we go. So like I was just saying, it's getting to become a lot more difficult to hire people nowadays. If you've driven around, you've stopped in restaurants, you've probably seen signs up that say, we're hiring, $500 bonus to apply, and if you get hired, we'll pay you a bonus. That's becoming more and more prevalent, whether it's a waitress or someone who's working at a job as a graphic designer or something, or engineer. They're paying bonuses to bring people into companies now. Totally new scenario than we had before. Our vacancies, that it's gotten to the point now that on single family homes, just like on selling single family homes, rental managing companies have started offering homes for rent on a bid basis. So you actually bid for what you're going to pay for rent. Again, never seen that before in my life, at least not in Arizona. And then Phoenix Suns. Big thing for Phoenix. Having the Phoenix Suns doing well certainly helps our economy, and downtown is benefiting a lot from that right now. Nationally, a lot of weird things are going on. We've got varied growth. Some markets are doing really, really well. Phoenix, some of the Sun Belt markets. Other markets are not doing so well. Some of the markets we talked about before. The Bay Area, we're starting to see move-outs. We're seeing rents drop. New York, Los Angeles to a certain degree, we're seeing changes that we didn't expect. And not all those people are moving in. A lot of them are moving to Texas. A lot of them are moving to New Mexico. A lot of them are moving to the Sun Belt states. Florida, for example. Multifamily is in the Sun Belt states. Again, that's where people are moving. Supply chain is still broken, but it's easing up. We're starting to see like lumber prices are going down, even though they were up. But steel prices are up 300%. So a little bit of a lagging process. We're told by the economists that this is not going to be inflation. It's going to be just a short-term blip. I personally think it's inflation. And that inflation's across all segments right now. Is a good point in case, look at trying to buy a used car right now. Used cars are up by 45% over the last 6 months. So if you bought a used car in January, congratulations, it's worth 45% more. Interest rates are steady, though we do have a little bit of flight to some of the treasury bills, which are hurting, but interest rates have been pretty so. That allows our values to keep increasing while as our rent's increasing. That's a good thing. Last thing, hospitality and travel are through the roof. If you tried to book an airline flight anywhere, either nationally or internationally, rates have gone up significantly. Flights have been decreasing, and if you're trying to find a flight, keep in mind, pick a flight that has a lot of options, because there's a good chance that flight might get canceled on a busy weekend. Some of the airlines have been canceling flights, not because of mechanical issues, but because they can't staff pilots, baggage handlers, or gate agents. So interesting time that hotels are full, restaurants are full, airplanes are full, but we can't. Some people can't even open restaurants full time because they can't staff them. So at Neighborhood Ventures, we've had a lot of good things happen. We've been able to drive our growth significantly this year, and we've been blessed by a number of factors. Probably the biggest one is that all the parts of our company, through all the trials and tribulations over the last couple of years, are starting to work at the same pace. So what I mean by that is we've got a fantastic property management company and a couple other ones we've worked with that's making our jobs easier. Our third-party construction company we have a good job of running our so our deliveries are on time, our projects are getting renovated, our paint's being done, our units are being turned, all the things that other companies are struggling with, including getting materials. We're able to execute on. So it's making our lives easier and making it easier for us to continue to grow. But it took a few years to get to this point, to get the right people in the right positions, have the right relationships. Our relationship with some of the major suppliers we work with has been fantastic. Getting appliances, getting paint at a time where people can't get appliances or paint. I know that sounds strange, but it's difficult to get those materials now. And then last thing is our relationship with lenders. We've noticed that marked change that 2 years ago, we were having to constantly explain to lenders we wanted to work with and do business with who we are, what we did, how we raise capital, how it all worked. Now it's become accepted. We've got a track record. The lenders are very easy to work with. They're supportive of what we're doing, and it's a welcome change. So this is really helping our ability to execute, and we're really happy to see it happen. So I just want to point that out. Made a lot of mistakes. We've learned a lot of things, but every one of those things have taught us to be better at what we're doing, finally.
Yeah, thanks, John. And welcome to all of you who are on the webinar with us, the live stream. We appreciate all of your support, and you're who allows us to do what we're doing. As you know, each of our projects have several hundred Arizonans who are supporting it, and you are a key part of our team. So we're excited to have you all on today and for taking the time. Hey, just one note, if you have any questions, there's a little squiggly, a little box with little lines in it, and you can ask the questions in there. And then as we come to those projects that we will talk about each of the projects, we'll answer those questions as we go. So piggybacking on what John was saying, right now we see Arizona as a great place to invest, both from a multifamily standpoint and real estate in general. And let me just start with multifamily. Through COVID, multifamily has become the darling of the commercial real estate asset class. We saw that during the COVID crisis, because people needed a place to live, they needed to stay in their homes. Again, the multifamily weathered the storm better than other asset classes. And this is something we always knew. We always knew that, commercial office buildings, they may not fare as well in these types of events, but you never know exactly what's going to happen. Out of COVID now, multifamilies really become the asset folks want to own. And we continue to believe that the trends around multifamily will be good for some time, especially in Arizona. One of the reasons is that it's an inflation hedge. So John just talked about what's happening with pricing and inflation. And the great thing about multifamily is, as if inflation happens, you can move the revenue from the property up as inflation goes up. If you own an office building and you have 20-year leases, you can't move those leases up. So multifamily is positioned really well in an inflationary market. One note, we did an interview with on our podcast, Kiss My Assets, with ASU econ professor Dennis Hoffman. He's an expert in economics in general, but also inflation and how that impacts real estate. So I'd really invite you to look at our 43rd episode. It came out a few weeks ago on our podcast, and it's about a 40-minute discussion about inflation and how real estate could be impacted there. And I think you'd find that very valuable. We also know that there's a housing shortage in general, and specifically in Arizona, which has driven up demand for homes and pricing for homes. And there is a shortage of vacancies for rentals as well. And as that continues to drive economics, the price continues to move up for apartments. We expect apartment rents will have moved up in the 10 to 15% range over the last year, which is a significant increase. The other nice thing about multifamily is the cash flow. So it's as we are on 3 of our projects right now, we're sending monthly distributions to our investors, and so it's a strong cash flow asset. And we all love cash flow in uncertain times. It's good to get those distributions in our account, and multifamily does that. Now, as you also know, we did our first project in the retail space, and we brought on an expert, Chris Lacoste, who joined our team because of his expertise in the retail space. And we have done our first retail acquisition. These are really opportunistic investments post the COVID reshuffling. And what I mean by reshuffling is you have folks who are moving, restaurants who have closed down, other retail tenants who are moving or have shut down, and now they may be coming back. But it really is an opportunity for us to look for underutilized properties. And these are properties that are in good locations, prime locations, but we see an opportunity to bring in some of these new tenants and do an adaptive reuse. And our Broadway project is a great example of that. We're bringing in Dunkin' Donuts. Dunkin' Donuts is expanding in the area. They've signed a 10-year lease, and we're taking a property that used to have kind of a sub, a lower credit tenant, and we're bringing in a Dunkin' Donuts type of tenant through our adaptive reuse. And we're also going in with Broadway. We're right across from a big new development, multifamily development in Tempe. So retail is more opportunistic right now for us, but we believe we'll continue to find retail opportunities as well. So we continue to believe in the Arizona market. We are not finding deals to just find projects. We pass on most projects and opportunities that we see, and we only select the ones and move forward with the ones that we see a really strong upside in, and in the multifamily and retail space. I wanted to just remind you of our, this is kind of our table of our progress in the 3.5 years that we've been operating. We've now had 3 properties go full cycle. We paid back on all 3 of those properties the 12% annual preferred return to our investors, and we've sold those properties earlier than the hold period, which is also our goal. And now we also have 3 projects that are generating cash flow, and we're paying monthly distributions via Hermosa, Mountain View, and 19th. And then we have 3 projects in the midst of renovation, so I'm excited to get into those and tell you about where those are at and hear John's comments on those projects as well. And before we do that, I just wanted to touch on our current project, our current fundraising project, Venture on Country Club. So this project it's now become our highest fundraised project with 1.6 million raised, 144 investors. We're 81% of our target. Our target's 2 million. Prior to this, our largest fundraise was 1.5 million with Venture on Elden. So now this has become our largest. And this is a 120 unit hotel to apartment conversion. And I wanted just to touch on briefly why this makes sense in our current market. The first thing is, as John mentioned, the hospitality business has come back, and it's come back strong. And the cash flow that can be generated on a hotel or a short-term rental is strong. It's actually stronger than apartments. But at the same time, the value, the back-end value, when the property is sold, is higher for an apartment. And a lot of that is due to the current sentiment around owning multifamily. Folks would rather own multifamily post-COVID than short-term rentals or hotels. So we're able to purchase a property, go renovate it, have it generate cash flow, and then convert it over a period of time within a year to an apartment building. And we will see a big increase in the value and the back end sales value.
Hey, Jamison, really quick, I'm seeing some questions come up, and some of the questions are property specific. So when we get to those properties, we can definitely answer those. Just wanted to let you know that those were coming through.
Great. So Venture on Country Club, we're currently fundraising now, and as I mentioned, things are going great. We're excited about this project, and now we'll turn into each of the projects, and we'll start to answer each of the questions. Some of the questions that have come through. Feel free to write your questions in, and we will get them all answered. As we go through each of the projects, we talk about the project life cycle, beginning with acquisition, then renovation, stabilization, cash flow, and then ultimate sale of the property. And then we also talk about the time frame and where we're at in the time frame, our expected time frame. So our first project is Venture via Hermosa. This project is performing at a very high level, generating strong cash flow. And we're just over a year, about a year and a third into this project. A few highlights from the financial side, and then I'm going to turn it over to John to talk a bit about the property itself. Our current average rent is $1,300 a month, but the market rent is $1,450. So as some of these leases come up, they will be moving up to that market rent, which will increase our revenue. And we began paying the 6% annual distribution in April. So if you're an investor in this, you'll either get a monthly distribution or you'll get the quarterly distribution. So we're excited where this property's at. And I'll pass it over to you, John, for the property updates.
Okay, so a lot of things is going on this property. We're 100% occupied. Got great feedback from the residents. The community garden is actually grown so big that one of the residents on the property every week harvests the vegetables and then distributes them to each one of the tenants in the property. It's kind of funky how that happens, but kind of cool. But the properties turned out better than we expected. So when we first leased the property up, keep in mind we leased up one side of the property during construction, and that allowed us to create some cash flow. But on the backside, we had to start off with lower rents. We wanted to make sure we were fair to the tenants by allowing them to stay there for a little bit cheaper rent while we're doing the renovations. Now we're bringing rents up to market. That's going to give us a lot of opportunity to increase the value of the property. And our game plan over the next 6 months is to start evaluating the property for a sale and at the end of sometime before the fourth quarter of this year. We already have a lower interest rate, real stable loan on the property, but I think we've hit maximum value for the short time, and it's time to start looking at that. We're going to figure that part out, but we're doing really, really well.
And then as we look at the outlook when it comes to cash flow, as you can see, the current rents in June were already profitable. But as we continue to move up the rents, as those leases expire to the current market rate, then you see the cash flow become even stronger. The great thing about owning multifamily is you have fixed costs like your mortgage and the other operating expenses, but as revenue increases, the fixed costs don't go up at the same level. So as the revenue goes up, your net income goes up as well. So we're very confident in this outlook. This puts the asset in a really good position to sell it, as John mentioned, later this year. And we will get to those questions. I see several, but we'll answer them as we go through each project. And then the ones we don't address, we'll answer at the end. But we want to keep the flow of this going. So venture at Mountain View, this is also now in cash flow. And this happened early. So kudos to our team, John, the real estate team, and our construction manager, who got this property stabilized, renovated, stabilized 5 months ahead of schedule. And we expected to start doing distributions at 1 year, and instead we did them at 7 months. And so kudos to the team. Average market rent at this property is $950. The market rent, or excuse me, the average current rent is $950. The market rent is $1,025. And I'll pass it over to John to talk about the other highlights of the property.
Yeah, so I was at the property yesterday. It looks good. It's running really well. We have 2 units that are in turnover, and the reason for that, we have units that are turning over. And we also have some existing residents that are there prior to our ownership whose leases have just come up. So we're going through and renovating those units and getting the higher rents. We had one thing we didn't expect, but this happens on properties. We just had to upgrade one of the electrical boxes for half of the property. Just a function of time and wear and tear on it. So we just had that done. It was done today and turned back on, and it didn't really affect too much of the property. We were able to do that without little effect on the property. Parking lot's been resurfaced. It makes the whole property look beautiful. And we've got 3 more units that we're going to be turning over the next, including those 2 units. So basically 3 units total we're turning over the next month and a half. Then we'll have all 26 units turned and start bringing rents to market. And then our game plan on this is to refinance the property sometime this fall, put lower interest rate, long-term debt with little to no prepayment penalty, creates even more cash flow for us.
There was one question by Greg about a distribution. And since we just started distributions on Mountain View, what that looks like is at 6% a year. And if you have a custodial account, we send that to you every month. We can talk to you more about a custodial account, but basically that's an account you can create with our trust company, and then you get the distributions every month. Otherwise, we send it to you every quarter, and that's done through an automatic distribution or automatic direct deposit into your account. And right now it's at 6% a year. So you can do the math based on how much your investment was and how much you would get every month or every quarter on that, but it's 6% a year. And just to kind of show you what this looks like. So as we finished second quarter at Mountain View, we didn't have the property fully leased. And so we had reserves to handle the loss as we operated and finished the renovation. And then as we turned to the third quarter, this quarter, since now we have it fully leased, that revenue number jumps way up. And that's and now we're in the black or the green in this case. And that's how we're able to start paying these distributions. So again, great job, John and the team, on turning this around faster. The faster we can have these projects renovated, leased up, the faster the cash flow comes. And as an investor, that's what we're looking for. So venture on Williams, this is in the renovation stage. So we are in the midst of renovations. One note and highlight to Rocky is she does great renovation updates at least once a month. And if you are a venture on Williams investor and you haven't seen those renovation updates, go to our YouTube and you'll find them, and you can see the progress of this property. The rendering we're looking at here is what it's going to look like when it's done. It doesn't quite look like this right now as we're amidst renovations, but it's actually looking very good. And as you can see from those renovation updates, a few highlights. When we purchased the property, average rent was $860 a unit, and we've already leased up 3 renovated units at $1350. So, it's a dramatic increase in the cash flow this property is generating. And our property manager expects that to go higher because there's a shortage of units, renovated units in this area. And our expectation going in is that we would have ultimately be at $1350 a unit, but we are already at $1350 a unit. So this property is also performing very well. These are the types of things that give us confidence when we look at our next projects. As we see lease-ups happening quickly, it gives us confidence to go in and move on the next project because we see those trends from our current projects. And so those insights really help us. And then, John, I'll turn it over to you.
All right. So as Jamison said, Williams has gone really well. We've been really busy on that property. It's been our main concentration with our construction crew. We've renovated over 50% of the units. As we said, we already have 3 units that are being reoccupied. As of tomorrow, we have the appliances being delivered for another 6 units. So we're going to have, I think we have 10 more units coming online over the next couple of weeks now. And little side note, our only frustration in the whole process, I'm getting all the materials we need. It's been labor to fabricate our countertops of all the things. So we actually have materials. We've just been slower on having the labor that renovates our countertops. So that slowed us down a little bit, but not slower than our schedule is supposed to be. We're expected to be done with the property by the end of August, probably more like mid-August at this point. And we're going to try to get some grass growing again. The pool area has been taken out. I won't go into too much detail, but we're going to have an event and have all the investors out there, but it looks absolutely gorgeous and it's turning the corner pretty quickly. But that project's turning out better than we thought. $150 rent bumps more than we thought we'd get on that property, which is a really good thing.
And I'm just going to answer a couple of questions I just saw. Yes, Dan, to your question, the plan for us is to always sell the asset. So we may change that as we get down the road, but right now our model is to find assets that are underperforming, renovate them, reposition them, get them stabilized, get them generating cash flow, and then we sell them. So each of the projects has a 2 or 3 year time horizon, and that's what we're good at, and so that's what we stick with. One other question is if there was a cap on the number of investors. There is no cap on the number of investors, so we will take as many investors as we can. The only distinction or the only limitation is they have to be Arizona residents to invest in our projects.
And Jamison, just to piggyback just a little bit on Williams, which is really kind of my darling right now. There have been a couple of times where people that are working on the building have actually made comments to me like, this is a place I would like to live. And of course that makes me feel good, but I think it does also speak to what Jamison was referring to earlier, and John, where we're getting better at this. And it's kind of an imperceptible shift, but with how smoothly it works between myself and Danny, and then of course, John overseeing a bunch of these, not only during the renovation stages, but also the slight issue at Mountain View that he mentioned that gets taken care of right away. The property management, it's all coming together on Williams, I think, in a really elegant way. And I'm excited to kind of promote the event that we're going to do the next month.
Yeah, we're excited to have all of you folks come out and see this property, especially if any of you saw it before we purchased it, and seeing the transformation. It's going to be an exciting event. And one other question that was asked is if we're committed to the full 3 year period, or is it going to be a little bit less? The 3 years is our target period. So we would like it to be around a 3 year time frame. It may end up being a little bit less. We try not to make it any more than that because we want investors to have some visibility into when you'll be getting your funds back. But it is just a target. It may end up being less than that. And it really depends on what the market's doing. And when we can sell the property at the point where we think it's reached its highest value, it just tends to take a few years to get to that point. All right, so venture on 19th. So this is one of the unique projects that we have. We only purchased this property a few months ago, and it's already generating cash flow because it was already fully rented, and it didn't require and doesn't require a major renovation. But there were opportunities for us to come in and add some amenities that would really take up the rents, including installing washer and dryers in some of the units and installing private patios. So currently the average rent is $760 a unit. The market rent is $900 a unit. And we will be increasing that by about $125 a unit as washer and dryers are added. And we already began paying distributions. If you're a Venture on 19th investor, you should have received your distribution already. You'll get them typically by the 15th of every month. And so I guess it's the 14th. So maybe give us one more day, but you may have already got it. We'd like to under promise, over deliver. But we began paying distributions on this project already, which is exciting.
All right, I'll jump in. My turn.
Yep.
So this project's turning out to be a lot of fun. One of the things I love about it is it's a fully operational property day one. The renovation stuff we're doing to it is to enhance the property. So as Jamison said, we don't have to tear this thing apart, and we'll be able to pay cash flow immediately. So this morning I was going over our schedule, looking at our rent changes and how we're running the property. We're over 90% occupied. Why aren't we 100% occupied? Because that's what I would ask. It's not 100% because we have units that are in the middle of being turned over, renovated a little bit, and so we can push the rents a bit and put in the washer dryers in. We just finished doing the roof on the property. So we have a new roof on this project. The parking lot's going to be done soon. The biggest thing that you'll see if you drive by the property, the new paint, that wasn't part of our original budget, but I'll tell you that we, because of some credits we got from the seller and because of some reduced costs we had on other items we're going to do to the property, we're able to apply that towards paint. So I'm not going to tell you how much we paid to have the property painted, but we got a really good deal because we used our own crews, our own construction people we've been working with. But you can see in the top left-hand corner of the picture, the patios are that flat black color. We added those, and it's doing really, really well. And by the end of August, we'll have all the work done, including the parking lot. And our plan is at that point just continue to raise rents. And I think we're actually going to shoot for I think our market rents when we get done, our top market rent is going to be over $1,025 for some of those one bedrooms.
Venture on Elden is our Flagstaff project, and we just acquired this a few months ago as well. Property is currently nearly fully occupied. Residents are paying $975, and the real opportunity here is with a nice renovation, the rents will move up significantly. This is in a really nice area of Flagstaff, and the property just hasn't seen any updates. It's been maintained but not updated. So as we turn to renovations this month, John will touch on that. Then we'll go through the process to renovate all the units and get them restabilized. And over to you, John.
Yeah, well, again, who wouldn't want to be in Flagstaff this time of the summer in Phoenix? Probably, I'm going to be up there on Friday. I've got to go pull some permits for us on the project. First thing we're doing to that project is we're painting the exterior. So the building was owned by the same owner. I think it was 30 years. Really nice gentleman who sold us the property, but nothing was really done to take it up to the next level. We're going to do that. So first thing is exterior paint, landscaping, and we're going to start all that stuff this next week. We've already got the paint purchased, and I think some of it's even on site. I even went out of my way to a few weeks ago. We pre-purchased things like countertops, solid surface countertops. I bought them in wholesale, bought them from a wholesaler, and had them shipped up to Flagstaff. So saving a bunch of costs on those things. We'll start the interior renovations sometime in August. Our construction crew wants to get up there now because it's 112 degrees and 95% humidity here in Phoenix. They want to get up there now. We've already got some units that are vacating at the end of the month, but we'll tell you that by end of August, we're going to be in full swing on that property. It's going to look a lot different, and we're really excited by so far what we're hearing from the neighborhood already about the kind of rents we're going to get as we start renovating those units.
And then our last update is Venture on Broadway. And this is the retail project that I mentioned earlier. Some great things that are happening here. Project fully funded. We hit 125% of our target goal, which was great. 165 investors. And then John has several updates to touch on today. And then as we get later in the year, we'll get some renovation update videos out to folks, but we're not quite there yet. John?
Yeah, so a lot of good things happening here also. A lot of things happen very, very quickly. So number one, our main tenant that is there now, Burger Rush, we restructured and re-signed a long-term lease with them, which made the current tenant very happy, made us very happy, creates a very stable tenant situation on that property. Dunkin' Donuts, I don't hear any applause here, but we should be all clapping. We got our lease signed with Dunkin' Donuts. Best thing about that, they agreed to even a little more space at a higher rent. And then we were able to work with the city to get the parking worked out, which allows us to have the drive-through they wanted in the right location. So we've been working through that. We're working through our final bids with an outside general contractor. It is a commercial project. It's very time sensitive, and we also have our crews very busy on our multifamily projects. So we've got a third party outside GC that's bidding the final work on the Dunkin' Donuts space, which works really well for us. And the city's been really helpful on working with us on parking, drive lane work, figuring out how the drive-through is going to work and the backup on it. And again, Dunkin' Donuts, knowing that we got our 10-year lease signed with a higher rent and for a little more space than we thought, is working out really, really well for us.
So just to piggyback on that, we're in the process of getting those final approvals. There's a lot of concern around drive-throughs at busy locations. If anyone has gone to a Chick-fil-A and sit in a drive-through, or a Salad and Go, or a Dutch Bros, or any of these places, the drive-through traffic is really extensive. So we're looking at different options of supporting the Dunkin' traffic. And one of the options that we're looking at is the small building on the east side of the property is potentially removing that to add drive-through traffic and signage. So we don't know exactly how that will play out, but we're really excited that financially that would actually be a better outcome than if we kept that property and couldn't have a drive-through. But bringing in a Dunkin' at the rate that they pay and having the drive-through capability and the ability to bring several cars in the drive-through is going to be really important. And John, also you might want to touch on these photos across the street.
Yeah. So Jamison was just saying, we've got the city working with us. We're going to, just to be very clear, we're probably going to end up taking out that small building, which is about 1,000 square feet on the Dunkin' space. That was going to be a bonus building for us if we could keep it. Turns out that it's not going to work, but it's going to give us more parking and more access to the Dunkin' Donuts and to the other tenant we add to that building. So just don't be surprised if you see a sign where the building was, and it works out better for us. Across the street's moving really quickly. Evergreen, who's building that apartment building, it's over 300 units. They're vertical on the whole property, including the site. That part of it, these photos are just taken the other day. So they're vertical right up to the street now. So when that gets open, I'm guessing by the looks of it, within the next 3 to 4 months, because they're going to start leasing the back side of the property, which they started building first, the very south side. That's going to be a fantastic thing for all of our tenants. Not to keep cheering the Dunkin' thing again, but one of the best things we have about this property is the fact that we're located right near Tempe High School. And we've heard from a few people that we expect that parking lot of ours is going to be full of high school students coming over getting coffee and donuts. So that works out really well for us, but lots of good things happening in the neighborhood.
And one of the things I really like about that property is if you saw the tenant profile before we purchased it, we've really gone from definitely a non-credit tenant who is very likely to have problems paying if there's a downturn, to a Duncan type tenant. And when we go to sell the building in a few years after it's stabilized, that really improves our ability to sell it, and to sell it at the level that we expect to. I want to turn now to a bunch of the questions that have been asked that we haven't got to. We apologize, but thank you for staying with us on this live stream, and some great questions. And I'll ask them, and Rocky and John will feel free to jump in on these too. So Mark said, when will Venture on Williams start to distribute cash flow? So we're about 2.5, 3 months into that project, and our expectation is by a year it will be renovated, really stabilized, and generating cash flow. And we would love it if it's shorter than that. On Mountain View, it ended up being 5 months early, but we don't send distributions until the property's generating cash flow, and that's what our expectation is. Let's see, Ajay, you mentioned third-party construction company and third-party property management. Is that a change in approach? I was under the impression that both of these functions and all other functions are in-house. I'll touch on that, and then John can touch on it. No, we've always had a third party doing our property management, because from my standpoint, it's not a business that I want to do internally. It can be a tough business. You really need to be good at it. And so we selected a property manager who John's known for years and does an excellent job, and who we trust to manage all of our properties. And they've managed, Marlette from then on through all of our other projects. John, you want to touch on that at all?
Yeah. So again, we want to spend our time doing what we do best, and we have some great relationships with our property management company and other companies we've worked with. As far as construction, I would call it a hybrid. We have our own dedicated construction people. They are a third-party construction company, but the benefit is we have 100% of their attention. It also includes all their subs and their suppliers. So we get all their stuff, but it's our dedicated crew, but it's a third-party company. I know that sounds a little bit evasive, but it's the best way to describe it.
Well, and one of the reasons why we do have those types of relationships, in the case of the Broadway project, we are bringing in a third-party general contractor to do that commercial build-out, and that's how we approach this. There's always a third party who's an expert in that particular space, and our crew is great at multifamily. And but if we need extra help, if we need help outside of their expertise, it's very easy to bring in somebody who's an expert in a third party, and that gives us the ability to focus on what we're good at, and part of that is managing them to make sure they deliver what they tell us they'll deliver. John, this would be a good question for you. What is your take on when there'll be full saturation in building homes and rentals in Phoenix, and where do you go when this happens? From George.
That answer has changed over the last 12 months. I would tell you that we are not going to be anywhere close to full saturation. I heard this 2 years ago. I saw a big article on the front page of the real estate section of the Republic 2 years ago, that we're not going to be able to keep up with construction. We're not going to be able to keep up with our demand for housing. And seeing what's going on in the multifamily business, the residential for sale business, we're not keeping up with it. Whether it's a function of being able to convert developable land to multifamily or single family, being able to get the supplies or be able to have the labor to build it, we're simply not able to keep up with the demand in our market. So I would tell you that looking forward today, I just read this morning that there's a couple thousand units of single family homes being planned for the West Side. It was in the Republic and Business Journal this morning. We still can't keep up with the demand. So it's been a long time since Phoenix has seen that happen, but we always seem to get there in our market, and we're still the darling. So I don't see it happening for quite a while.
Well, and I think to your point, I think that's a great question, because that's ultimately what we do. I think Country Club is actually a really good example of of when there's not enough housing. We hear this over and over from a lot of property managers, especially in Mesa. And so to look outside a typical situation and being able to do a hotel conversion that makes a lot of sense, not only from a financial point of view from our end, but also from a community standpoint. They need housing, and we're ready to do that.
So Mark asked a good question. When will you do away with the preferred or reduce the preferred return and allow us to participate in the upside at the exit of the property? So actually 12% is a lot of the upside of the property. And there's a long story about how we ended up deciding to pay our investors a preferred rate. I'll share it briefly. Our initial project, we were not paying our investors preferred. We were going to pay them along with us. You as investors, if the project did good, you might get a 13 or 14% return. If the project didn't do as good, it might be a 5 or 6% return. And we didn't have a lot of success bringing in investors that way. And it was confusing to folks, and they felt that there was quite a bit of risk there because since we are the ones managing the project and you as passive investors, you don't have any, hands-on involvement. We ended up changing it to paying a 12% preferred. And just to clarify that, what that means is you get paid that 12% first before common equity or before us as a company gets to take any of the potential profits on a project. So it reduces your risk as an investor because it's in a preferred position. And as you can see from our current projects, we make about 6% in cash every year, and all of that goes to you. We don't take any of that cash as the company. The cash is all distributed back to investors, and then the other 6% that you get for that year comes when we sell the property and make a profit. So the 12% we found is a really sweet spot for folks. You're getting a double-digit return by investing in local commercial real estate. You're not having to do any of the work or deal with the phone calls on a Saturday night that their air conditioning has gone out. And maybe some of you have done that before. You've been landlords before and you realize that it is a lot of work. So it's worked out really well. And our investors have appreciated and loved it, and it's worked out well for all of us. John, do you do 1 year, 2 year, or longer leases?
In this market, I'd love to just do month-to-month leases. I know that would sound weird to some people, but rents are moving so quickly. Jamison said it earlier today, and I keep telling this to everybody on our team. I expect to see 15% rent increases now in 2021. So whatever the rent was on any property in January, 15% higher by December. And on the ABI side, we're underwriting properties almost again and again every month when we're looking at go to market because the rents are moving so quick. So the answer is we don't sign long-term leases. The market's not requiring us to do that. And if someone isn't happy with the property or they aren't willing to pay the new rents, we have the ability to bring in another tenant as quickly and move rents up. And it's just the reality of the market. So what I really want, month-to-month leases on all of our properties. What do our lenders want? Year leases on all of our properties.
Yeah,
but we have a combination.
Yeah, so there's a bit of a mix, and John taught me that as in a market that's moving like ours, it's many times to our advantage to keep it at a month-to-month. But we have a mix of year leases, 6-month leases. I don't think we have anything over a year lease on our multifamily project. No. So good question from Patty. As a passive investor, does that mean the most I can lose is $1,000, or can a creditor come after me if the company fails to pay the bills? Now, Mark already answered that. So you're right, Mark. So he said it's an LLC, creditors cannot come after you. So one of the things that you'll read in the operating agreement for the LLC is that you as an investor are a limited partner in the LLC, meaning if there's any liabilities to the LLC, none of those can be attached to you. Your risk is only in your investment. John and I, as the managing partners, we have a lot broader responsibilities in the LLC, including managing the property correctly, hitting our timelines. And not only do we have investors, but we have lenders that we have to be accountable to. But as a limited partner and a passive investor, your risk is limited to your investment amount. I think we answered Greg. Sorry, Greg, if it was really hard to hear us. We'll work on that for next time.
It's loud in my ear. I don't know. They good.
Well, Greg gave us a good comment. Boy, you're rocking Williams a lot faster than you thought. Yeah, it's we're hitting more of the gears are spinning and connecting, and things are gelling. And it takes a little bit of time to do that. But to John's point, that's why we're confident as we move into the next project that we can execute it. Has there been any thoughts about looking at low-income housing opportunities in Phoenix? I know there's not be as much money to be made in that type of project, but hearing more and more about that need in the area. That's from Dan. John, you have some thoughts on that?
Yeah. So ABI Multifamily participates and is a big sponsor of Arizona Housing Fund, which is helping to raise money to help produce some sustainable low-income housing. I'm a big fan of low-income housing. I know we need housing at all levels. For us, for our company, it's a difficult proposition at the moment, mostly because of the way we have to pay our returns, the way the properties are structured, the kind of debt we put on them. And also the size of the projects we're working on. Most times, sustainable, subsidized housing, lower income housing, affordable housing isn't going to be small projects or medium-sized projects. They're usually much larger projects. So at scale, you can produce more stable cash flow on a larger project. So the answer is we're looking at everything. There might be times we look at some point building apartment buildings. There might be times we look at doing some, if the market comes back on single family well enough. I haven't even talked to Jamison or Rocky about this, but we might get to the point where we're back to seeing condo conversions again. We might do projects like that. We're open to everything. We just want to make sure we can handle what we're working on, and we have a core competency in what we work on, and more importantly, overall that we see that the project works out well for our investors. So that's all these things are on the table.
Yeah, and ultimately, the real answer to keeping housing affordable is to bring additional units on the market. And there is some pushback from folks in Arizona who don't want additional buildings being built in their neighborhoods, and there's a lot to work through there. But ultimately, we have to be open to housing folks that move here, or else what happens in California can happen, where there's housing just gets so expensive, and so I'm excited about what we're doing at Country Club, taking away a hotel that's there that isn't a great asset for the neighborhood, and bringing another 120 units on the market in an area that needs them. One question here, and I think, John, you could address this from Greg, is about the rezoning for Country Club. And just to put that in perspective, we expect to rezone the property from a hotel to an apartment building, and that will take somewhere under a year. While we're doing the rezoning, we're going to operate the property as a short-term rental, which we have a lot of experience in, and that will generate strong cash flow. But we do ultimately expect to rezone it to a hotel, to an apartment building. John, can you touch on kind of that risk? He's saying there's, what's the risk there that it doesn't get approved, and what do we do if it doesn't get approved? So it's a good question.
Sure. So to put in perspective, there's always risk in any kind of project we take. We try to minimize that. If we're building apartment buildings from scratch, from ground up, tearing down something, taking vacant virgin land and turning into apartment buildings in the neighborhood, that's probably considered to be one of the higher risks. But I will tell you that in Arizona, it's not a matter of if you get approval, it's a matter of when. The question about rezoning that project is it's already existing. It's 120 units there. It operates, it feels like an apartment building. It has full-size kitchens. So a lot of the things that we'd have to do to a building to get further approvals are already in place. How long does it take? Well, a lot of the cities are still in this post-COVID situation where they've got a backlog of zoning cases. So we're looking at, it could be as simple as 4 months, or it could go as long as 9 months. We don't have the exact answer yet. We're in the process of working on the rezoning process. But the good thing is, as Jamison just said, we have a plan to operate it for cash flow until we get that in place, the new zoning in place. And the new zoning in place, I'm going to be very, very clear about this. The Airbnb short-term rentals that we're going to do are significantly more profitable, but a lot more work. What happens is we turn it into an apartment building with approvals from the city. There are owners out there that do these and they never get approvals. They just run them like an apartment building. Problem is, down the road, when you go to sell it, the next buyer can't get traditional financing. They can't get a Fannie or Freddie or agency loan on the property, which negates some of the value of the property. So we have the opportunity to go through the process, do it right, create the cash flow in the meantime, and then get the final approvals from the city to allow us to run it as an apartment building, which either means we can put a long-term fixed rate, non-recourse, low interest rate, traditional apartment loan on it, or the next buyer can. And that's where we get the biggest bump in value. That's the easiest way you can answer it.
Does Elden have a similar 6% distribution rate from Barbara? Yeah, that is our expectation, Barbara. Once that property is renovated and stabilized, that we would pay out a 6% cash distribution rate to investors. Jeff, how many projects do you envision being open simultaneously? You know, I think part of it is we're learning and we're figuring out what is our capacity as a team. And we have a really strong team, as we've emphasized. You may only see me and John and Rocky in the videos, but there's a whole team of us. Thankfully, even a webinar, a live stream like this takes a whole team to prepare. And over the 3.5 years we've been operating, we've really built a strong team. So as long as we still continue to find deals that we feel like have strong upside that we can execute on, that's really going to be what determines how many projects that we do. Okay, I think we're getting almost to the end. With Taiwan Semiconductor coming to North Phoenix, have you considered new construction in that area? I don't sense that there is much renovation inventory for you to purchase. This is from Jeff. So John, I'll let you touch on that.
Yeah, just in general, look, we all know it. All the land is north and south and far east and far west. So we specialize in trying to renovate projects in neighborhoods that we feel are up and coming. It's less risk for us, entitlement risk, construction risk, material risk. If we ever and when we ever get in construction, we'll probably be more of a in-town developer for a while if we get into that phase. But certainly there's going to be bigger demand for housing around, whether it's the chip plant in North Scottsdale or the chip plant for Intel in Chandler or other areas. Thing is, that's really not where our core competencies are right now. We are not capable right now of building a building in those markets. So we're going to do what we do best, which is renovate projects and find opportunities in retail and office, possibly, and certainly multifamily.
And I think Ajay just piggybacked on what we were talking about earlier. He said his experience with most real estate-based investments is that if you get more than 12% on a consistent basis, it's either extremely lucky or requires too much risk. And I'll just say multifamily investing that we're doing is it's kind of what I would consider vanilla investing. We're taking an existing asset that's already generating cash flow and just taking it up a notch. So the risk level is lower than if we're building something from scratch or some of these other real estate projects that are out there. And that also means that the reward isn't going to be 30 or 40% returns. But to get a double-digit return like what we pay with a lower risk investment, that's really the sweet spot. It's always about risk versus reward. So we want to keep that risk for our investors as low as we can and deliver that reward. So I appreciate Ajay jumping in there. You may have mentioned this, but when will Mountain View be making its first distribution? So you should receive that by tomorrow, Chris. If you check your account, Rocky mentioned this, that on your account statement, it will come from Prime Trust, who is our trust company, and you should receive that distribution by tomorrow. Hey, I'm going to turn it over to Rocky. I think we got all the questions, and Rocky, you get to hit some of this final good stuff here.
Yeah, thank you so much. And I will say to your point that there's a whole team that makes all of this happen. A lot of the questions that you might have later, I know that in these kind of situations, I always think of them after everyone's signed off. They are really ready and willing to help, either by support at neighborhood.ventures or just call our office, and you can reach a couple of the people here that are so willing and able to answer those questions. So our investor calendar, looking at the next quarter, we are going to be doing 2 in-person events and then another live stream. So the cadence is we want to do something every month to connect with our investors or to give you a chance to connect with us. And certainly you don't have to, but we would love to see you. We're going to do a Venture on Williams open house from 8 a.m. to 9 a.m. on August 7th. And the only reason that's the only one I'll really drive home, because we're so excited about it. I'm on that property almost every day. And it's just turning out beautifully. And I think that it's satisfying as an investor to see actually what your dollars are doing. We're going to do another happy hour. And then, of course, you're going to get your distributions if you have a custodial account monthly. And if you don't have a custodial account, you'll get them quarterly on October 15th when we get to see you guys again a couple of days before on the live stream. So thank you all so much for joining in with us, and we'll see you next time.